Hi, my name is Charles Miano, Senior Investment Associate at Nabo Capital, and today I will be taking you through the Q1 2022 fixed income report, just to give you some highlights when it comes to interest rates, when it comes to the exchange rate, when it comes to inflation, as well as the overall GDP growth in Kenya for the year. So starting off with interest rates, we note that interest rates have been on an upward trend. For the most part, when it comes to the secondary market or when it comes to the bonds, the Kenyan bonds specifically, the local ones, we've seen them go up across the tenor by 57 basis points. What I mean by this is across what we see, or what we call a yield curve, where you have the time maturity on what they call the x-axis, and then on the y-axis you have the interest rates. We've seen those rates shift from if you compare December 2021 to March 2022, we've seen those rates go up on average by 57 basis points. This has been driven largely by huge domestic debt accumulation by the government. We note the government since July of 2021 all the way to April, sometime post-April, at the time we're shooting this video, they've borrowed about 508 billion Kenya shillings, which makes about 76% of the amount that they're looking to borrow by the end of the financial year, which should be by the end of June 2022. And so due to huge debt accumulation as well as lower liquidity in the market, we've seen rates shoot up quite a bit. In addition to that, touching on exchange rate, we note that the Kenya shilling has depreciated. In 2021, it depreciated by about 3.7%. In the first quarter of the year, we've seen it depreciate by about 1.6 to 1.7%, and trading at around 115.3 to 115.5 Kenya shillings at this time. There's an expectation due to high dollar demand and thin dollar inflows coming in, because as we note globally, the US interest rates are on a rise. The Federal Reserve, which is the central bank of the United States, did increase their policy rate by about 25 basis points. So when the rates are going up in this sort of what we call a hawkish environment, what that means is that the dollar instruments, bonds for example, become more attractive, and hence you have more foreigners opting to invest their money there as opposed to maybe investing in local markets such as ours. And in this case, we've seen that pick up, and also due to the global economy, especially with the global risks that are prevailing, especially with higher commodity prices on the back of the Russian-Ukraine conflict, which we did have a video about, which you can check out just for more details around the impact of the Russian-Ukraine on Africa. We've seen higher commodity prices. So oil at the moment, oil prices are at the highest they've been in over 7 years. At the time, at the end of March 2022, the price of Brent oil was about $107, and at the beginning of the year it was around $74. So we've seen a significant jump there of almost about 36%. So oil prices are up. We've seen also other commodities such as agricultural products such as wheat, corn, also being on the rise. So with that higher inflation expectation, because as those prices are going up, we're seeing inflation tick up quite a bit. We're seeing a situation where central banks are raising their rates. For Kenya, however, the central bank the rate for the central bank, or what is called the monetary policy rate, has remained even at 7%. In the last MPC meeting, or Monetary Policy Committee meeting, they left it at 7%. Inflationary expectations still remain high. However, they have remained quite moderated within the target range of 2.5 to 7.5%. As at March 2022, the inflation was about 5.6% from 5.2% in February 2022. The reason why it hasn't jumped significantly is due to the fuel subsidies that the government has provided. Yes, we've seen the oil prices, especially the petrol prices on the ground, go up. However, they have been subsidized quite significantly by the government, in this case supported, in a case where this, for example, petrol prices for super will have been about around $155 per liter. Currently it's around $134, but expected to rise about 3 to 5% in April on the back of revisions. And that subsidy has significantly cushioned consumers and also cushioned the inflation rise, or the second round effects of that inflation that could have come from fuel prices. These subsidies have cost about 10 billion. I expect it to cost about 10 billion in April for the government. So it's quite a significant cushion that is temporarily being held. So we continue to observe whether that will be the case going forward, whether they'll be able to keep the subsidies, even or they'll be able to, they might reduce on those subsidies, which could also have subsequent effects in increasing energy prices on the ground. But also we have seen food inflation go up, and other commodities, as you can see, as people have observed going to the supermarkets, going to and noticed notable price increases. So food has gone up, energy has been contained, but only temporarily. And we do note that expectations for GDP growth still remain high, despite some risks that continue to prevail. For example, the risks that are expected is within the election risk. In addition to that, there's also the global risk rising from the Russia-Ukraine conflict, which is affecting commodity prices, and that's expected to affect, especially when it comes to our current account deficit. We do note that the current account deficit was expected to increase, to rise to be around 5.2%, but has been revised to about 5.9%. This is because we're importing more at higher prices compared to the expectations at the beginning of the year. And we're importing for the 12 months running until March. We were importing, our importations had grown importations have grown about 25% relative to our exports, which have grown by about 12%. So there's a huge deficit there compared to what we're exporting and what we are actually buying from external markets, even though they have been cushioned a bit by flows that we've received from the World Bank, as well as flows from diaspora, which have been on a sort of generous run rate, 22% for the 12 months till March 2022. So overall, the CBK expects this year GDP growth to grow by about 5.9%. This is on the back of improved local or domestic conditions, such as better favorable rainfall, lifting of health restrictions, specific sector improvements, which have seen some companies grow over the period since the pandemic, and also the hotel and tourism has been on an improvement. There was a hotel survey that was carried out that that at least most hotels are running, and they are about 80% and above in terms of capacity, or in terms of staff capacity specifically. So there is an improvement there. We've seen some improvements when it comes, we've seen some growth when it comes to education, manufacturing, trading sector, as well as retail sector. So with that, all we do expect at least some optimism to run through to the second quarter. We do expect interest rates to continue being on the rise due to tighter liquidity, and for the Kenya shilling as well to remain on a depreciating path due to a strengthening dollar. And that's it from us. Thank you very much.